Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe Simple Sound. Today we're diving into the world of international investing, exploring the exciting opportunities and potential pitfalls of venturing beyond the US stock market. Today's episode is based on an insightful article titled Global versus US Stocks: Understanding International Investing on safesimplesound.com website. This piece highlights the often overlooked fact that the US market represents less than half the world's total stock market value, emphasizing the diversification benefits and growth potential available globally. It also provides practical advice on how to access these markets, from ADRs to ETFs. We've structured this episode to provide a clear and comprehensive guide to global investing. First, we'll explore the diversification benefits of global stocks, using scenarios like the 2008 financial crisis and tech sector concentration to illustrate the power of a globally diversified portfolio. Then, we'll shift our focus to growth opportunities in international markets, examining scenarios involving emerging market growth and industries dominated by non-US companies. After that, we'll navigate the challenges of global investing, discussing the impact of currency fluctuations and geopolitical risks. Finally, we'll tackle the crucial question of choosing the right investment vehicles, comparing ADRs versus direct investments, and exploring the role of ETFs and mutual funds in building a global portfolio. So, grab your coffee, settle in, and get ready to expand your investment horizons. Let's start with a specific scenario: the 2008 financial crisis, to illustrate how a globally diversified portfolio can weather a significant economic storm. Imagine two portfolios, one heavily invested in US stocks and the other diversified across both US and international markets, including emerging economies. During the 2008 crisis, the US-centric portfolio suffered significant losses as the subprime mortgage crisis rippled through the American economy. However, the globally diversified portfolio demonstrated greater resilience. Sam, can you help us understand why? How can geographic diversification mitigate risk during a global economic downturn?
Simply put, diversification reduces your reliance on the performance of any single market. During 2008, the U.S. was the epicenter of the financial crisis. A portfolio solely invested in U.S. stocks would have been fully exposed to that downturn. A globally diversified portfolio, however, would have also included exposure to regions less impacted by the subprime mortgage crisis, like some emerging markets that were experiencing robust growth, driven by internal demand rather than reliance on U.S. financial markets. This broader distribution of assets helps cushion the blow when one region faces a significant challenge.
So if I understand correctly, it's like having multiple baskets of eggs instead of putting all your eggs in one basket. If one basket falls, you haven't lost everything.
Exactly, Taylor. That's a perfect analogy. Sam, can you give us a historical example to demonstrate the resilience of international markets during U.S. market downturns, perhaps beyond the 2008 example?
Sure. Consider the lost decade in Japan during the 1990s. While the Japanese stock market stagnated, other regions, including the U.S. and emerging markets, experienced growth. A globally diversified investor during that period would have benefited from the performance of those other markets, offsetting the poor performance in Japan. Another example would be the dot-com bubble burst in the early 2000s. This primarily impacted U.S. tech stocks, while other sectors in international markets were less affected.
That makes sense. Different economies don't always move in the same direction. So during 2008, while the U.S. market was plummeting, some emerging markets, as you mentioned, were actually thriving, providing a buffer against the overall portfolio losses. It's almost like having a backup generator when the power goes out.
That's a great way to put it, Taylor. So, to quickly recap, geographic diversification helps mitigate risk by spreading your investments across different economies. When one market struggles, others may perform well, reducing your overall portfolio volatility. As we've seen with the 2008 financial crisis and other historical examples, relying solely on the U.S. market can expose you to significant risk during periods of economic turmoil.
And it's important to note that while emerging markets can offer significant growth potential, they also carry higher risks. So it's not about abandoning the U.S. market altogether, but rather strategically allocating a portion of your portfolio to international markets to achieve a balance of risk and return. As the additional context mentioned, a common starting point for international allocation is around 20 to 40% of your stock portfolio, but this should be adjusted based on your individual risk tolerance and investment goals.
Excellent point, Sam. This discussion really highlights the importance of a well-diversified portfolio. Before we wrap up, Taylor, any final thoughts?
I think the key takeaway for me is understanding that relying solely on one market, even a large one like the US, can be risky. Diversifying geographically can offer some protection during economic downturns, similar to the examples of 2008 and Japan's lost decade.
Perfectly summarized, Taylor. Now, for our listeners, we encourage you to review your portfolio's current international exposure and assess its ability to withstand future economic shocks. Is it adequately diversified, or is it overly concentrated in a single region? Consider your investment timeline, risk tolerance, and overall financial goals when making these decisions. We're continuing our discussion on the benefits of global diversification, and this time, we're diving into a specific scenario: tech sector concentration risk. Imagine two investors, one heavily invested in U.S. tech stocks and another with a broader global tech exposure, including companies in Asia and Europe. Let's say there's a downturn specifically impacting the U.S. tech sector. What are the risks of concentrating investments in a specific sector within a single country? Sam?
The risk, Alex, is quite simply putting all your eggs in one basket. If that basket falls, you lose everything. A sector-specific downturn in a single country can significantly impact your portfolio if you're overly concentrated there. Think of it like relying solely on one crop. If a disease hits that crop, your entire harvest is ruined. Diversification, in this case, would be like planting a variety of crops.
So, if I understand correctly, if I only invest in, say, US tech stocks, and something negative happens that specifically affects that sector in the US, my portfolio could take a much bigger hit than someone who also has tech stocks from other parts of the world.
Exactly. Let's say new regulations are introduced in the US that negatively impact the profitability of tech companies. An investor solely focused on US tech would feel the full force of that impact. However, someone with exposure to European or Asian tech companies, where these regulations might not exist, would likely experience a less severe downturn.
That's a great point, Sam. And Taylor, that brings us to our second question. How can global diversification within a sector, in this case tech, provide downside protection?
Diversifying globally within a sector provides a buffer against country-specific risks. Think of the 2000 dot-com bubble burst. While it significantly impacted U.S. tech stocks, other regions weren't affected to the same degree. A globally diversified tech portfolio would have likely fared better.
So even if the tech sector as a whole is facing a downturn, the impact might be felt differently in various regions due to factors like government policies, economic conditions, or even consumer behavior, right?
Precisely. As the context material mentioned, different countries have varying regulatory frameworks, economic strengths, and even cultural preferences that can affect specific sectors.
And remember, Taylor, this isn't just about avoiding downturns. Global diversification can also unlock growth opportunities. Maybe European tech companies are specializing in a niche area that's booming, while U.S. tech is experiencing slower growth in that particular area. A global portfolio allows you to capture these international growth stories.
So let's recap. Concentrating investments in a single sector within one country exposes you to significant risk. Global diversification within a sector, like tech, can provide downside protection by reducing your exposure to country-specific risks and potentially capturing growth in other regions. It's like having a safety net for your portfolio.
So, even if I'm bullish on tech, it makes sense to consider diversifying within the tech sector by looking at companies in different parts of the world. That way, I'm still invested in the sector I believe in, but I'm also reducing my risk.
Exactly. And remember, this principle applies to other sectors as well. Now, for our listeners, we encourage you to analyze your portfolio for sector concentration. Are you overly reliant on one particular sector, especially within one country? Consider diversifying both geographically and across different sectors. It's a crucial step in building a resilient portfolio. In this next segment, we're diving deeper into the exciting world of international investing, specifically focusing on the growth potential of emerging markets. We've already talked about diversifying beyond US stocks, and now we want to explore how emerging markets like India or Indonesia, with their rapidly growing GDP, expanding middle class, and favorable demographics, could potentially offer higher returns compared to developed markets like the US. So, Sam, let's start with the big picture. What are the potential long-term growth prospects of emerging markets compared to developed markets?
Thanks, Alex. The long-term growth potential in emerging markets is generally considered higher than in developed markets. Think of it this way. A mature tree, like the U.S. economy, has already done a lot of its growing. It still grows, but slower. A younger tree, like an emerging market, has more room to grow quickly. This is often reflected in higher GDP growth rates. Emerging markets often experience rapid industrialization, urbanization, and technological adoption, all fueling economic expansion.
So, if I understand correctly, while the US market is stable, it might not offer the same growth potential as, say, India, which is experiencing rapid development.
Precisely. Imagine investing in the U.S. auto industry in the early 1900s versus investing in it now. The early 1900s offered explosive growth potential. Now, the industry is much more mature. Similarly, many emerging markets are currently experiencing a phase of rapid growth, offering potential investment opportunities reminiscent of the earlier stages of developed economies.
That's a great analogy, Sam. Now, this brings us to a crucial question. How can investors balance the higher risks associated with emerging markets with their potential for greater returns?
Good question, Alex. The key is diversification and careful selection. Don't put all your eggs in one basket, especially a potentially volatile one. Consider a mix of established and emerging markets, perhaps starting with a smaller allocation to emerging markets, say 5 to 10% initially, depending on your risk tolerance.
This reminds me of what we discussed about diversification in episode 31, Building Your Stock Portfolio, part of this U.S. Equities Education series, which you can find in our show notes. Diversification helps manage risk, right? But how do I choose which emerging markets to invest in? It seems overwhelming.
Absolutely, Taylor. Diversification is key. You can start with broadly diversified emerging market ETFs or mutual funds. These funds invest in a basket of companies across different emerging markets, mitigating the risk associated with investing in a single country. Later, as you gain more experience and knowledge, you might consider investing in individual companies or country-specific funds.
So to recap, emerging markets offer higher growth potential due to factors like rapid industrialization and a growing middle class, but they also carry higher risks. Diversification through ETFs or mutual funds can help manage this risk.
So, if I were interested in long-term growth and willing to take on a bit more risk, it might make sense to allocate a small portion of my portfolio to emerging markets, right?
That's a reasonable approach. Remember that even within emerging markets, there's a spectrum of risk. Some markets are more politically and economically stable than others. Research and due diligence are essential. For example, India's expanding middle class and growing tech sector presents a different risk profile than a less developed market with more political uncertainty.
Excellent point, Sam. That brings us to a learning checkpoint. Remember, risk and return are generally correlated. Higher potential returns often come with higher risks.
This is all incredibly helpful. I'm starting to see the appeal of emerging markets for long-term growth.
Great, Taylor. So, to wrap up this segment, we've explored the growth potential of emerging markets, discussed how to balance risk and return, and emphasized the importance of diversification. As a call to action, we encourage you to do your own research on emerging market opportunities and consider if including them as part of a long term growth strategy aligns with your overall investment goals and risk tolerance. We're continuing our exploration of global investing, and in this next segment, we're diving into industry dominance outside the US. We've talked about diversifying beyond US stocks, and now we'll look at specific industries where non US companies are truly leading the charge. Sam, Taylor, ready to explore some exciting opportunities?
Definitely, Alex. I'm especially curious after reading that article you sent, the one about global versus US stocks. It mentioned how some industries are dominated by non US companies, and I'm eager to learn more about specifics.
Happy to shed some light on that, Taylor.
Excellent. So, to kick things off, which industries are showing greater innovation and growth outside the US, Sam?
Several come to mind. Renewable energy is a big one. Think of wind turbine manufacturers like Vestas in Denmark, or solar power giants like Trina Solar in China. These companies are at the forefront of technological advancement and have significant market share globally. Another area is luxury goods. European companies like LVMH, which owns brands like Louis Vuitton and Dior, hold considerable sway in this market.
So, if I understand correctly, even though the US is a huge market for luxury goods and has its own brands, European companies are still dominating globally. That's interesting.
Precisely. They've built strong brands with global recognition and sophisticated supply chains.
It's like the NBA. While there are great basketball leagues around the world, the NBA is seen as the premier league, attracting top talent globally. Similarly, certain industries have centers of excellence outside the US that draw in top talent and innovation.
That analogy makes sense. This reminds me of what we discussed about emerging markets and their growing middle class. They're creating huge demand for these products, right?
Absolutely. And it isn't just emerging markets. European luxury brands, for example, have strong demand in established markets as well.
Great point, Sam. Now, our second question: how can investors gain exposure to these leading international companies?
There are a few ways. One is through American Depository Receipts, or ADRs. These are essentially certificates that represent shares of foreign companies and trade on U.S. exchanges. So you can buy them through your regular brokerage account, just like any other stock. Companies like Toyota and Alibaba have ADRs.
That sounds much simpler than trying to buy stocks on a foreign exchange. The article also mentioned ETFs and mutual funds. How do those work for international investing?
ETFs and mutual funds are probably the easiest way for most people to invest internationally. They offer instant diversification across multiple companies and countries, often at a lower cost than buying individual stocks or ADRs. There are funds specifically focused on certain regions, like Europe or emerging markets, and others that provide broad global exposure.
To recap, we've talked about industries where non-US companies are leading, like renewable energy and luxury goods, and how investors can access these companies through ADRs, ETFs, and mutual funds. Taylor, any final thoughts?
This has been really helpful. I'm starting to see the potential of looking beyond US borders for investment opportunities. It can feel a bit overwhelming, but having these concrete examples and knowing there are accessible options like ETFs makes it seem much more manageable.
Absolutely. And remember, you don't need to become an expert overnight. Start small, do your research, and gradually build your international exposure.
I agree. And keep in mind the broader context. International investing isn't just about chasing the hottest trends. It's a crucial part of building a well-diversified portfolio for long-term growth.
Excellent points. For our listeners, your call to action is this: do some research. Identify some global industry leaders that interest you and explore investment options like ADRs or international ETFs. We're continuing our discussion on navigating the challenges of global investing, and in this segment, we're diving into the sometimes tricky waters of currency fluctuations. As we discussed earlier, investing internationally opens doors to diverse markets and potential growth, but it also introduces currency risk. So Sam, Taylor, let's explore this. Taylor, I'll start with you. How do currency fluctuations affect returns from international investments?
Well, From what we talked about earlier, it seems like it's a two-way street. If the US dollar weakens compared to the foreign currency where I've invested, my returns get a boost when I convert them back to dollars. But if the dollar strengthens, then my returns are reduced, right?
Precisely. Imagine you invest in a Japanese company. If the yen appreciates against the dollar, your investment, when translated back to dollars, will be worth more. Conversely, a stronger dollar diminishes those returns.
Great point, Sam. It's like buying a souvenir on vacation. If the dollar is strong, you get more souvenirs for your buck. If it's weak, you get fewer. Now, Sam, how can investors manage this risk? The article we have talks about currency-hedged investment strategies. What are the advantages and disadvantages of using those?
Currency hedging aims to neutralize the impact of currency movements. One advantage is reduced volatility. Your returns are less influenced by currency swings, which can be especially beneficial in volatile markets. However, hedging has a cost, which can eat into your returns. Also, if the dollar weakens, you won't benefit from the currency boost.
So, if I understand correctly, hedging is like buying insurance against unfavorable currency moves. It protects me from potential losses, but it also limits potential gains. This reminds me of what we discussed about options in a previous episodes, limiting downside while potentially capping upside.
Excellent analogy, Taylor. Sam, could you give us a concrete example of how this plays out?
Certainly. Let's say you invest $10,000 in a European index fund. If the euro appreciates against the dollar by 10% over the year, and the fund's underlying value remains unchanged, you'd have a 10% gain simply due to currency fluctuation. Now, with a hedged version of that fund, you wouldn't see that 10% gain, but you'd also be protected if the euro depreciated.
Okay, so it's a trade-off. Hedging offers stability, but potentially sacrifices gains. But wouldn't the cost of hedging also reduce returns, regardless of currency movement?
Yes, the cost of hedging is a key consideration. It acts as a drag on returns, whether the currency moves favorably or unfavorably.
Let's quickly recap. Currency fluctuations can significantly impact international investment returns. A strengthening dollar reduces returns, while a weakening dollar enhances them. Currency hedging can mitigate this risk, but also comes with costs and limits potential gains. Taylor, any final thoughts?
I think the key takeaway for me is to understand my risk tolerance and investment horizon. If I'm investing long-term, perhaps the currency fluctuations will even out over time, and hedging might not be necessary. But if I have a shorter time frame or a lower risk tolerance, hedging might be a good option.
Absolutely. Sam, any final words?
Just to emphasize Taylor's point, understanding your individual circumstances is paramount. Currency hedging is a tool, and like any tool, it needs to be used appropriately.
That's a great point to wrap up on. Thanks, Sam and Taylor. For our listeners, we encourage you to learn more about currency risk and consider hedging strategies if appropriate for your risk tolerance and investment horizon. We're continuing our exploration of global investing, and in this segment, we're diving into a crucial aspect: geopolitical risks and market volatility. Essentially, how do things like trade wars, political instability, and even pandemics impact your international investments, and what can you do about it? Sam, let's kick things off. How can these geopolitical events impact international investments?
Geopolitical events can create significant ripple effects in the international markets. Think of it like a web. A political shift in one country can impact trade relationships, currency values, and investor confidence in another, seemingly unconnected part of the world. A trade war, for example, can disrupt supply chains, increase prices, and impact the profitability of companies reliant on international trade. Political instability can lead to capital flight, currency devaluation, and even market closures.
So, if I understand correctly, even if I don't invest directly in, say, country X, an event there could still impact my investments in country Y if they have strong economic ties.
Exactly. This interconnectedness is key to understanding geopolitical risk. A simple example is if country X is a major supplier of raw materials to country Y. Instability in country X disrupts supply, affecting production and potentially stock prices in country Y.
That's a great point, Sam. Taylor, this reminds us of what we talked about in episode 31 of our U.S. Equities Education series about the importance of diversification within your portfolio, right? This expands that concept to the global scale.
Right. Diversifying within the U.S. market helps protect against company-specific risks, but diversifying globally helps protect against country or even region-specific risks. So what can investors do to manage this kind of risk, Sam?
Several strategies can help mitigate geopolitical risk. Diversification, as you mentioned, is crucial. Spreading your investments across different countries and regions can cushion the blow if one area experiences turbulence. For instance, during the 2008 financial crisis, while U.S. markets were severely impacted, some emerging markets showed greater resilience.
Let's unpack diversification a bit more. It's not just about investing in different countries, right? It's about understanding the different levels of risk associated with developed and emerging markets. Sam, could you elaborate on that?
Absolutely. Developed markets like the UK or Japan generally have more established regulatory frameworks and more stable political systems, potentially offering lower but steadier returns. Emerging markets like some in Asia or Africa offer higher growth potential, but also come with higher political and economic risks. Think of it like choosing between a well-established company with a consistent track record versus a promising startup with high growth potential, but also a greater chance of failure.
So a mix of both, tailored to my individual risk tolerance, makes sense. This is where the concept of asset allocation comes into play, like we discussed earlier in the series, right? I might allocate a smaller percentage of my portfolio to higher risk emerging markets and a larger percentage to more stable developed markets.
Precisely. And regularly rebalancing your portfolio is crucial to maintain your desired asset allocation as market conditions change. Another important strategy is staying informed. Keeping abreast of global events can help you anticipate potential market impacts and adjust your portfolio accordingly.
Alex brings up a great point. It's also crucial to focus on investing in quality companies with strong fundamentals, regardless of their location. These companies are generally more resilient to market fluctuations and geopolitical headwinds.
So let's recap. Geopolitical events can significantly impact international investments due to the interconnectedness of global markets. Diversifying across different regions and countries, understanding the varying risk profiles of developed and emerging markets, staying informed about global events, and focusing on high-quality companies are key strategies for mitigating these risks. Remember to tailor your international investment strategy to your own risk tolerance and financial goals. As a call to action, stay informed about global events and diversify your international holdings across different regions and countries. This can help you navigate the complexities of global investing and potentially enhance your long-term returns. We're continuing our discussion on global investing, and now we're diving into the specifics of how to invest internationally. Specifically, we're tackling ADRs versus direct investment. As a quick recap, American Depository Receipts, or ADRs, allow you to buy shares of foreign companies on U.S. exchanges, while direct investment means purchasing stock directly on a foreign exchange. Sam, Taylor, are you both ready to unpack this?
Absolutely, Alex. This is a topic I've been curious about, especially after our last discussion on the benefits of global diversification. I understand the why behind global investing, but the how is a bit fuzzy.
Happy to clarify things, Taylor. It's a common question.
Great. So, Sam, to kick things off, what are the key differences between ADRs and direct investment in foreign stocks?
The core difference boils down to access and convenience versus control and cost. ADRs offer simplified access. They trade on U.S. exchanges in U.S. dollars, and they generally follow U.S. reporting standards. Think of it like buying a pre-packaged international vacation. Everything's arranged for you. Direct investment, on the other hand, offers greater control, potentially lower costs, and access to a wider range of stocks not available as ADRs. It's more like planning your own trip. More flexibility, but more responsibility.
So if I understand correctly, with ADRs, I don't need a special international brokerage account. That's a huge plus for someone like me, still relatively new to investing.
Exactly. Many regular brokerage accounts offer ADRs. Take Toyota, for example. You can buy its ADR TM just like any other U.S. stock. Direct investment, however, would require an international brokerage account and navigating the Japanese stock exchange.
That makes perfect sense. Now, regarding investor profiles and goals, which approach would you recommend for different investors, Sam?
For beginners or those seeking simplicity, ADRs are generally a good starting point. They're a convenient way to dip your toes into international waters. For more experienced investors comfortable with international markets, or those seeking specific companies not available as ADRs, direct investment might be preferable. Think of a seasoned traveler who prefers the freedom and customization of planning their own itinerary.
This reminds me of what we discussed in episode 32 about ETFs versus individual stocks. ETFs offer broad diversification, similar to ADRs providing easy access to international markets, while individual stocks like direct investments offer more control but require more research.
Excellent connection, Taylor. Now, Sam, are there any downsides to using ADRs?
While convenient, ADRs can sometimes have higher costs compared to direct investment due to management fees. They also might offer slightly lower liquidity than the underlying stock on its home exchange.
So, for instance, if I were to invest in, say, a Brazilian company through an ADR, I might face higher fees than if I bought the stock directly on the Brazilian exchange.
Precisely. And the trading volume might be lower for the ADR, potentially impacting the price you get.
Let's recap. ADRs are generally more suitable for beginners due to their simplicity and accessibility on U.S. exchanges, while direct investment offers more control and potentially lower costs, but requires more experience and an international brokerage account. Sam, anything else our listeners should consider?
Yes, the article mentioned currency risk. With direct investment, you're directly exposed to fluctuations in the foreign currency. This can amplify gains if the dollar weakens, but can also reduce returns if the dollar strengthens. ADRs are still influenced by currency movements, but the mechanics are a bit more complex. It's a crucial factor to consider.
So for long-term investors, these currency fluctuations might even out over time.
Exactly. Long-term perspective helps mitigate this risk.
Fantastic discussion, both of you. To wrap up, we explored the key differences between ADRs and direct investment in foreign stocks, focusing on accessibility, cost, and control. We also touched on the important aspect of currency risk. As a call to action, I encourage everyone to research ADRs and direct investment options to determine the most suitable approach for your individual needs and experience. Think about your comfort level, investment goals, and risk tolerance. We're continuing our discussion on global investing, and in this segment, we're diving into ETFs and mutual funds as vehicles for international exposure. As a quick recap, we've established the importance of diversifying beyond the U.S. market for potentially greater returns and reduced risk. Now, let's explore how ETFs and mutual funds can simplify this process. Sam and Taylor, what are your initial thoughts on how these investment vehicles make international investing more accessible?
Well, Alex, from what I understand, buying individual stocks on foreign exchanges can be a real hassle. Different currencies, time zones, and regulations. It sounds like a headache. But with ETFs and mutual funds, it seems like you're getting a pre-packaged basket of international stocks, right? This reminds me of what we discussed about diversification in episode 31, building your stock portfolio. Is it similar?
Exactly, Taylor. ETFs and mutual funds offer instant diversification. Instead of researching and buying dozens of individual international stocks, you can gain exposure to a broad range of companies across different countries with a single purchase. They essentially do the heavy lifting for you, simplifying access to global markets. And yes, the diversification principle applies here just as it did in our earlier discussion on portfolio construction.
Perfect analogy, Sam. It's like ordering a pre-made salad instead of buying all the ingredients separately and chopping them yourself. So to follow up, what factors should investors consider when choosing which international ETF or mutual fund is right for them?
That's a great question, Alex. Expense ratios definitely come to mind. We talked about those before, and I know they can eat into returns over time. And I'm guessing the management style matters too, right? Like, is it actively managed or passively tracking an index?
Absolutely. Expense ratios are crucial, especially for long-term investments. A seemingly small difference in fees can compound significantly over the years. As for management styles, You have actively managed funds where a manager picks the stocks, aiming to outperform the market. Then you have passively managed funds, often index funds structured as ETFs, which aim to replicate a specific market index. Active management generally comes with higher fees, while passive management tends to be more cost-effective. There's also the fund's specific focus. Some might target specific regions like emerging markets or developed Europe, while others offer broad global exposure.
So, if I understand correctly, Sam, investors need to consider expense ratios, management style, and the specific region or country focus of the ETF or mutual fund. Is that a fair summary?
Yes, and I'm also thinking about things like the underlying holdings of the fund. For example, if I'm interested in, say, Japanese technology companies, I would want to make sure the ETF or mutual fund I choose actually has significant exposure to that sector.
Precisely, Taylor. You can often find detailed information about a fund's holdings in its prospectus or fact sheet. That allows you to see the specific companies it invests in, giving you a clearer picture of your actual exposure. For example, the VX-US ETF is a great option for broad international exposure, excluding the US.
Excellent point. To recap what we've covered so far, ETFs and mutual funds simplify international investing by offering instant diversification and professional management. When choosing between them, consider factors like expense ratios, management styles, active versus passive, and the fund's specific regional or country focus. To wrap up this segment, we encourage you, our listeners, to investigate different international ETFs and mutual funds. Compare their features, expense ratios, past performance, and think about how they align with your overall investment goals and risk tolerance. Don't be afraid to dive into those prospectuses and really understand what you're investing in. And that concludes our deep dive into the world of global investing here on Safe Simple Sound. We explored the compelling reasons to look beyond U.S. borders, drawing insights from the article Global versus U.S. Stocks, Understanding International Investing. We covered the diversification benefits, potential growth opportunities in emerging markets, and how to navigate challenges like currency fluctuations and geopolitical risks, touching on key differences in market structure and corporate governance along the way. I found the scenarios comparing portfolio performance during the 2008 crisis and the discussion about industry dominance outside the US particularly illuminating. They really highlighted the power of diversification and the potential for discovering exciting investment prospects globally. A huge thank you to all of you for listening in today. Your engagement with these topics is what makes Safe Simple Sound thrive. Be sure to check the show notes for all the links and resources we mentioned. And if you enjoyed today's episode, please leave us a review and share it with someone who might also benefit from these insights. It helps more people discover the podcast, and we deeply appreciate it. In next episode, we'll be shifting gears in corporate actions and how they affect your investments. Don't miss it. Until then, this is Alex, wishing you a profitable week and reminding you to always invest wisely.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.